Good afternoon, everybody, and welcome to the Wednesday Lunchtime Drive-Through on today, Wednesday, March the 22nd. My name is Damon King. I'm a certified financial planner, professional, and wealth manager with ChappelWood Financial Services. And I also serve as the lead instructor for ChappelWood University, which is the educational arm of ChappelWood Financial. And today's topic is one that is very top of mind, right? It's about the banking crisis. Or is it a crisis? I don't know. That's kind of what we're going to talk about today. Obviously, the last couple of weeks have been dominated by this headline. Although today, the day that we're recording this, the Federal Reserve is scheduled to announce what they're going to do with interest rates. Fully expect them to raise it another quarter of a point. And then what they do after that, I think a lot of it is tied to the banking situation that we have right now. And you might be asking, hey, how come you guys haven't really come out and said anything more about this sooner? You know, it's been 2 weeks or so. And the reality is we were still gathering information. There's a lot of stuff that was known, a lot that was unknown, but has since come out. And I'm going to be sharing with you an actual letter, or more of a post that I received from a bank president, kind of giving her insights into what led to all of this with SVB Bank, Signature Bank, that sort of thing. So, as always, please, if you've got any questions or comments, you may use the chat or Q&A boxes down at the bottom. You just hover over your little toolbar right there, and you'll see those come up. And you can use either one of those to ask any question or make a comment. I'll just start off by saying I am not a banking insider. I'm not a banking industry expert. That's not where I've spent my career. So if you do have more insights into the banking industry because you spent a lot of time there, I really would be interested, as would everybody else, to know your insights. If you have anything special to share on today's show. So let's go ahead and get into this. And let's first start by talking about what exactly happened. You know, what is this banking crisis that everybody is talking about? The big news coming out in the last couple of weeks was that two U.S. banks, SVB, located in Silicon Valley, California, and Signature Bank, located in New York, both collapsed under the weight of excess customer withdrawals. It was an old-fashioned run on the banks, and there were more withdrawal requests than cash on hand to meet those demands, and as a result, those two banks collapsed. It shook public confidence in the banking system, as you might expect, but that also caused the stock market some anxiety. People get nervous about anything, doesn't matter. The stock market almost always reacts because the stock market is largely driven by emotion, how we feel in the moment, or how we feel about the future. And by future, I'm not usually talking about even the next year. Stock market moves based on how people feel about next week. Certainly, we don't want to invest that way. We don't want to build long-term plans based upon people's feelings for about next week. But obviously, it does have some impact on how we invest, at least in the short term. And then, as you would expect, the FDIC, the Federal Deposit Insurance Corporation, took control of both banks in an attempt to protect depositors at those banks, and at a larger level, protect the integrity of the banking system, our faith in the banking system. I mean, it's kind of interesting that there are a lot of nuts and bolts that go behind our economic system, our banking system. But when you really get down to it, a financial system is really largely supported by the faith, the confidence that we have in it, right? Even our own currency. Yes, it says Federal Reserve note on a dollar bill, backed by the full faith and credit of the United States government. The United States government only has credit, only has power because we as the people give it power, right? We have confidence that our government will step in and back that dollar. But in reality, the value of a currency, any currency, is largely dependent upon the people who utilize that currency believing that it has value. So all of this in many ways is a very delicate house of cards. Now, cards that are backed up by a lot of assets, but still very dependent upon faith. Luckily, the government did step in very quickly, the Treasury Department, the FDIC, the Federal Reserve, and they took action to calm the fears that were generating right at that moment about the banking system. And they came in and basically said, hey, even if you've got more than the $250,000 FDIC protection limit, we're going to go ahead and make sure that all depositors are made whole. We're going to cover all deposits. Now, keep in mind, it was not a bailout of the banks. They were not stepping in to keep those banks open. Those banks are still in receivership. What they were doing is backstopping the depositors so that consumers, investors had full faith and confidence in the system. So that's what happened. But how did it happen? So here's a quick lesson. And again, I'm sure you already know this, but it's just a quick little lesson on how do banks work, okay? So banks take deposits. You put your money in and thousands of other people do too. Well, the banks don't just keep that money there. Obviously, they loan a lot of that money out in exchange for interest payments that they can then turn around and give you some interest payments. But they also invest a lot of that cash in fixed income assets like bonds or US Treasuries. Now, since the financial crisis, up until last year, interest rates were historically low. They'd been very low for a long time. And as a result, the interest rates that you got on bonds was also very low. So you paid a very high price to acquire those bonds, but you were receiving a low rate of interest. So the value of the bond at that point in time was its underlying face value, not necessarily the income that it was producing. But here's the problem with bonds, especially long-term bonds, which is what these two banks were invested in and what a lot of banks invest in. The longer the term of a bond, meaning the longer it takes for you to get your money back, because if you hold a bond to maturity, you will ultimately get all of your money back plus all the interest. All right. So that's why bonds are safe. But from a practical standpoint, very few people actually hold on to bonds all the way to maturity, certainly long-term 15 or 30-year bonds. Usually they get sold much sooner. And as a result, you're not going to get all of your money back. And the longer the term of a bond, the more susceptible that the value of that bond is to a change in interest rates. So a 1% change in interest rates can make the value of a bond fluctuate wildly, up or down. When interest rates are low or going down, bond values go up. But when interest rates rise, bond values go down. So we had a perfect storm in 2022. We had historically low rates for a long time. So the bonds that most people and most banks owned at the beginning of 2022, they had paid a premium for, and they were getting very paltry income payments. Then interest rates rose significantly in 2022, and that caused the value of their bond portfolios to go down. However, the interest rates, if you're holding on to the same bonds, stay where they're at. Interest rates don't suddenly go up on that bond. If you bought a bond paying a 3% interest rate, regardless of what happens to the underlying price of that bond or value, the interest rate stays the same. So the banks, especially these two banks in question, were heavily exposed to bonds, and they saw the value of those bonds go way down, but the income that those bonds were paying was still very low. That left them extremely open to interest rate risk and liquidity risk, meaning that they have these assets that are not worth as much now, and they're not paying any income or very little income. And that's a recipe for disaster. But SVB and Signature banks had additional risks that were self-inflicted that caused this. All right, because any bank is susceptible to this type of risk. All banks invest in bonds. All right. All banks are subject to interest rate risks, liquidity risks. But what was it that SVB and Signature did that really caused problems for them? And is that a situation where most banks are doing the same thing, or was this really isolated to these two banks? So SVB's customers, if you look at Silicon Valley, as you might expect, being in Silicon Valley, they leaned heavily toward venture capital firms and tech startups. Those were their primary customers. In New York, Signature Bank was also heavily exposed to technology, but also very heavily exposed to cryptocurrency, Bitcoin, things like that. Startup tech companies, venture capital firms, crypto, very volatile assets, very volatile to put your money, most of your money there. It would be like you going out and investing in only growth tech companies. When technology is killing it like it did in 2020, did you know that SVB Bank in 2020 had one of the highest deposit growth rates in the entire country in 2020? Why 2020? That was the year of COVID. What happened? Which industry really took off in 2020? Technology. We were all stuck at home doing this, Zoom. All right. So a lot of the companies that they were invested in, the technology took off and they had a great year. Their deposits went up something like, I don't know, 100x or something. I don't know. It was some ridiculous number. But the problem is that venture capital firms, tech startups, companies that are mining for cryptocurrency, they are very big spenders of money. They pour millions of dollars into products and projects that do not immediately produce a profit. The only real reason to own a stock is because of its ability to appreciate in value, right? I mean, why else would you own a stock? Why else would you own ownership in a company except for its ability to grow in value and thereby grow your portfolio? And for the most part, the value of any company is heavily dependent upon its ability to generate revenue and profits. So if you want to be moderate to conservative, you want to invest in companies that are going to generate a good profit. But if you want to take more risk and you now are banking more on the growth potential, you're going to get into industries that are more dependent upon growth. They don't produce a lot of income, but there is that promise of growth. And that is, you're expecting a home run. You're hoping for a home run. These kinds of companies borrow a lot of money to fund their operations. Venture capital firms, these tech startups, they're not producing a product most of the time. They're still in the research and development phase. So they borrow a lot of money to fund their operations. That's great when interest rates were low. Not so good when interest rates go up. Now it's more difficult to fund their operations by borrowing cash. So if they don't really have, if they're not publicly traded and they can't just issue more shares of stock to raise money, where are they going to go to fund their operations? In the case of SVB's clientele, since they couldn't borrow more because it was too expensive, they went to their bank where they have millions and millions and millions of dollars in cash saved. And they expect that that money will be available when they need it. The problem was that SVB had loaned way too much money to a lot of these risky companies, and a good portion of their overall asset base, more than 50%, was tied up in those bonds that were going down in value and paying hardly any income. So combined with loaning too much to risky companies and degradation of their bond portfolios, there was not enough cash left to meet the withdrawal demands of their clients. As a result, they collapsed and the government had to step in. So that was what caused it at a high level. All right. Basically, these two banks were overexposed, just like you. If you go out and you put all your eggs in one or two baskets, you're really gambling that those two things are going to take off. That's why you don't put everything in one basket, right? You spread the risk around. Banks do the same thing, or they should. Businesses should do the same thing. In the case of SVB and Signature, they didn't do that. But there were other risks that led to these banks' failures. Self-inflicted wounds, all right? So, for example, there was poor portfolio management, all right? In fact, I would say there was probably a failure of leadership, a failure of management at the board level, a failure of management at the executive leadership level. If they had simply managed their portfolio of assets better, instead of resulting or relying so much on these long-term bonds. Again, SVB Bank had about 55% of their assets in these long-term, low-paying bonds. All banks invest in bonds, but they don't carry that much in bonds. In fact, the industry standard that I've since learned is closer to 25, 30%, basically half of what SVB had, all right? And they're much more cash heavy. They have more cash reserves on hand than what SVB did. Also, most banks are very cautious about their depositor base and who they're loaning money to. They diversify that risk across different types. They don't have just one type of client depositing millions of dollars. And if that one client or that one industry goes under, it was similar to what happened in Oklahoma City, right? During the oil bust. You had many banks that were very heavy in deposits from oil companies. And when the oil market went, so too did those banks, right? So having more cash on hand would have been much safer. And here's the deal. These banks were complying with regulatory requirements for the most part, all right? But their assets were not in line with industry averages. Now, I want to share with you, this is not me, okay? This is my disclaimer. I did not write this letter, but this is one that was shared with me through my contacts in the banking industry. And I just want to read what this bank president, she's in West Virginia, this is her perspective on why this happened to these banks. She says, as a community bank executive reading the news surrounding the collapse of Silicon Valley Bank, I'm appalled. Top executives in that bank sold millions of dollars of shares in the weeks prior to the collapse. They went without a chief risk officer for 8 months during one of the fastest rate rising environments on record. Their business was concentrated heavily on startups financed by venture capitalists, which is extremely risky in itself. Now, she goes on to say that they did invest billions of dollars into long-term fixed rate investments. Well, that's not in and of itself strange. Lots of banks do that. But what she references is that there was no management, there was no turnover of their bond portfolio. And they didn't exchange lower paying falling bonds for now cheaper bonds paying a higher interest rate. If they turned over their bond portfolio a little bit, yeah, they would have locked in some losses, but they could have exchanged those then for higher rating or higher paying bonds. I don't know how much that would have saved them. Might have just kicked the can down the road for a little bit. But the point is that maybe a little bit of management. She goes on to say, this is just another example of disparity in size and scope. Small banks like mine manage our risk every single day. When we are examined, we spend hours showing how we model and manage interest rate and liquidity risk, regardless of the rate environment. We show that we don't throw all our eggs into one basket and create concentrations of risk that could harm our customers should the rate environment change. This is just another example of why where you choose to bank matters. Just because a bank is ranked by Forbes or is the cool bank like Silicon Valley, again, these are her words, not mine, it doesn't mean that it's run in a way that properly manages risk. If you want to put your money into a bank online or through one of the non-bank providers, please do your research. Community banks by nature do not take on this level of risk exposure. We live and work in the communities we serve, taking local deposits and making local loans while properly managing our risk so that we remain safe and sound in any environment. And she goes on to end with, my door is always open. Now, this is a bank president, okay? My door is always open. Customers are welcome to stop and ask questions. It is the passion of myself and other community bank executives to make sure you are comfortable with your bank and you know that we do not take your trust in us for granted. So I was very impressed by a bank president who I'm sure she's a very busy woman. You can call her. You can walk into her office and go talk. So by all accounts, these two banks, SVB and Signature, I haven't found anything that suggests that they were blatantly breaking the law. But it's clear that there are certain industry standards that they were not meeting, industry averages that they were not meeting, and therefore that led to their decline. Now, here's another issue. All right. This is a chart that shows what percentage of their domestic deposits were uninsured, meaning deposits above the $250,000 FDIC limit. It's all well and good to get big and grow. Okay, there's nothing wrong with growth, nothing wrong with growing your business. But in the case of banking, Silicon Valley and Signature had an extremely high percentage of their deposits that were uninsured, meaning that they were very high on raking in the dollars, sucking up all the dollars that they could get. But then there were not enough safeguards in place to protect against a run on the bank. And you see some other banks here. First Republic Bank was also in the news recently. You see some really big names here that have, a high number of uninsured deposits. But obviously Silicon Valley and Signature Bank were off the charts in terms of the percentage of their deposits that were not insured. Most banks are not operating at this level of risk. Okay. Some other questions. My question was, where were the regulators? Okay, this was obviously this did not happen overnight. All right. It didn't even happen in the last couple of years. It's clear that this was growth over a long period of time. And in a period of time when interest rates were so low that these companies, who are very cash intensive and need a lot of funding, they could get to money anytime they wanted it. But those days are over. So my question then is, where were the regulators in all of this? After the 2008 financial crisis, there was an act that was signed in 2010 called the Dodd-Frank Wall Street Reform and Consumer Protection Act. Most people just call it the Dodd-Frank Act. There's a lot to that act, but the basics were that it was designed to reorganize the financial regulatory system. It even created new government entities to protect consumers from exactly what we just saw. Financial fraud, financial abuse, whatever. Where was all of this machinery over the last several years while this storm was brewing, right? So I'm not 100% convinced. In fact, I'm not even 50% convinced that what is happening with our banking industry has anything to do with the true health of our banking industry. I believe that these banks are more at fault for causing their problems than anything else. But I do question, where are the safeguards and why weren't they triggered? This is one reason why Fed Chairman Powell is taking a lot of heat right now over this. Treasury Secretary Yellen is taking a lot of heat over this. There's a reason why this whole situation, echoes of 2008, right? When Lehman Brothers collapsed. Here's something that shocked me, okay? Going back to SVB Bank. Now, this is what I heard, and I'm pretty sure it's true because I've checked it with different sources. I don't exactly know what his role was at SVB Bank, but one of the executives at SVB Bank was also a risk executive for Lehman Brothers Bank right before its collapse. I'm thinking, how the hell does this guy even still have a job in the banking industry? How? And yet he's at this bank. And now the second bank that he's worked at that has collapsed under suspicious circumstances, right? So obviously, these kinds of things are going to continue to happen. But the real question for us is it a systemic banking industry issue, or is it more some bad actors who took on more than they could chew, took bigger bites than they could swallow? And are the regulatory mechanisms in place to protect us, are they doing their job? What will the fallout be? And again, if you've got questions or comments, and if you've got some insights into this that I don't have, because again, I don't work in the banking industry. I never really did. So I'm just doing the same research that you probably have done, and I've got access to a lot of research here. But what will the fallout be? Well, will there be more bank failures? Let's see. We do have a question here. Jennifer. Hi, Jennifer. Good to see you again. Jennifer says, it's interesting that Barney Frank worked to strengthen regulations after the 2008 collapse, but loosened them later after he joined one of the bank boards. Now his bank is in trouble. It is interesting how that happens, right? Money corrupts. We know that. All right. It drives me crazy when people misquote the proverb, money is the root of all evil. That's not the proverb. The love of money is the root of all evil. That's the proverb. Money is a very valuable tool. As Jennifer knows, who works in the nonprofit world, money is an extremely valuable tool and necessary tool to help and serve others. And I personally believe that philanthropy should be a big part of anybody's financial plan, especially when you've built up a significant amount of assets. Giving should be part. Victoria said it the other night at an event we had. You give to get. But yeah, people can say one thing, but when money's involved, they may change their tune, right? So that's a great point. Thank you for sharing that, Jennifer. So will there be more bank failures? I don't know. I would say there probably will be, because here's the deal. There are thousands and thousands of banks across the country, and it's unlikely that it was just these two banks, SVB and Signature, that are heavily leveraged or are overexposed in risk. As of December 2022, U.S. banks had $620 billion in unrealized losses on their balance sheets. And those losses, okay, so it's like you don't really lose until you sell, right? Now, you take a look at your statement and your account balances are down, but you don't really lose until you sell and liquidate those assets. In the case of SVB, they had too many calls on deposits or withdrawal requests. So what do they have to do to meet a lot of those? They had to go and sell off a lot of those bonds that had fallen in value. They were forced to liquidate depressed assets in order to keep up. And even that wasn't enough. There are many banks that have unrealized losses. They don't plan to sell those assets, but if they get into the same bind, they're going to have to sell those assets in order to meet depositor demands. And there's $620 billion in unrealized losses on balance sheets. More than $1 trillion in deposits right now are uninsured. So I don't know, maybe it's time for us to, as a country, to revisit the role of the FDIC. Maybe $250,000 isn't enough. I mean, I don't know when that number was created, but it was clearly created during a time when the amount of wealth in this country was much less than it is now. But here's, to me, the encouraging thing. All right, even though these numbers are true and they are quite concerning, most banks have far more liquidity than SVB and Signature banks did. They have far less risk exposure because they're not concentrating all of their loans and deposits in just one industry. More banks may fail. And I will tell you that one of the reasons that these banks are put in jeopardy is because interest rates are going up. The Federal Reserve has kind of helped trigger this. I mean, we have been saying that the Federal Reserve will continue raising rates until either inflation comes down to where they want it or something significant breaks. Well, failures of two of the largest banks in the United States, that's a significant break, right? Something broke. So now the question is, okay, if the Fed raises rates today, which it's now 1 o'clock Central Time, which means we should find out here in the next few minutes what the Federal Reserve decided. I'm looking to see here. I'll try to share it with you in real time once it comes up. I don't see anything yet. Oh, yep, here it is right here. It came in 17 seconds ago. The Federal Reserve, or the Federal Open Market Committee, did decide on a rate hike of 25 basis points, 1/4%. So they did go ahead and raise rates as we expected, 1/4%. Chairman Powell will speak in 30 minutes. So we're going to end here in just a little bit. And if you want to go Google Fed Chairman Powell's comments, this is what I'm listening for. They raised rates 1/4%. We expected that. But because of this banking situation, are they going to stop? Did those governors in their meeting today have a conversation? Let's go ahead and raise rates now like we planned to, but maybe we should pause, because if we continue raising rates, yes, we'll continue to push inflation down, but at what cost? At what cost to our banking system? All right. Looks like we have another comment here. Are credit unions a safer option? I think maybe relatively safer, Wendy, because credit unions by their nature are member owned, right? As opposed to shareholder owned. Well, outside interests. Okay. So you are an owner in your credit union. I belong to a credit union and I am an owner in my credit union. So generally speaking, yes, I think credit unions are probably a little bit safer, but that doesn't mean that they're not subject to the same risks, because they basically manage their money in the same way, right? But in general, I would say that the smaller your financial institution is, the greater chance there is that you can actually pick up the phone and talk to the president or a high-level executive within the institution. You're not going to call JP Morgan and get to talk to Jamie Dimon, okay? But there is something to be said about banking with your smaller community bank, where you can actually meet the people that work there and answer your questions. Jennifer says, should the Fed stop bailing out the banks? Well, they're not bailing them out right now. So again, this is not a banking bailout like with Lehman Brothers. Now, other banks have gotten together to bail out some banks. But so far, all the federal government is agreeing to do is to insure and make whole the depositors that had their money at those banks. They don't care about the shareholders or the bondholders of those banks. Any of the equity holders of those banks are out of luck. So again, should they stop bailing out the banks? Yeah, probably. I mean, it could cause chaos in our banking system, but one way to get somebody one way to stop people from doing stupid is to make them face the consequences of doing stupid. And if you remove all of the consequences, what are people going to do? The same crap they've always been doing. So more banks may fail, but personally, and from what I've heard others say, I believe it will be more likely due to let me go back. I believe it will be more due to overexposure of risk on the part of those individual banks rather than a systemic issue within our entire banking system. I don't believe that there is a systemic problem within our banking system. I believe that most banks are doing the right thing. They are managing their risk well. But these make big headlines, and one or two bad apples spoil the whole bunch, right? So I still have confidence in our banking system. Now, that being said, if you've got $1 million with one bank, you might want to consider spreading that money around to different places. I will tell you this, here at ChappelWood, we actually have access to a cash deposit option where you can actually save up to I think it's $1.25 million by spreading around to 5 or 6 different institutions through our investment partner, 250,000 at this bank, 250 at this bank, 250 at this bank. And if you're interested in that, I can actually share the list of banks that they use. Now, what is going to be the impact on the market? Well, obviously, the stock market relies heavily on investor confidence. That's pretty much all that it's based on, as well as profits, but it's based on our confidence that these companies are going to profit tomorrow, so let's invest. And if we don't think they're going to profit, we pull our money out and the market comes down, right? The market is future looking. And the collapse of these two large banks eroded confidence overnight, and it caused the market to come down. Now some time has passed by, and now we're on to the next big disaster. Now we're concerned about China today, and tomorrow we're going to be concerned about interest rates, and tomorrow we're going to be concerned about Russia, and tomorrow we're going to be concerned. There's always something to worry about. But I am curious to hear, will the Fed stop raising interest rates because of the possibility that they could further damage the banking system? This is not the 2008 financial crisis, but there is going to continue to be volatility in the market, which means that maybe it's time to reposition. We have repositioned for many of our clients. And I'm not talking about going all to cash. I'm talking about making surgical, strategic changes to portfolios to reduce risk exposure. Maybe instead of leaning more towards growth, we lean more towards income. It's not every client. In fact, I have many clients that are like, hey, this is a buying opportunity. I'm going to pour more money in. But if you are in retirement or near retirement and you want to dial down on your risk, maybe we increase dividend stock exposure, maybe increase your bond exposure. Okay, there are ways to do this. And income is a great way to reduce risk, well, over the long term, but especially over the next several months that are likely going to be volatile. Okay, we've answered those questions. All right, I am going to wrap up here. I apologize for going a little later, but I wanted to leave you with one final thing. Is your bank safe? I don't know, but call your bank president. If it's a smaller community bank, chances are they will take your call. Now, you might have to schedule a time or appointment to talk with them, but I'm on LinkedIn all the time. And Jill Castilla over at Citizens Bank, I mean, she's all over saying, call me, I will talk to you. I mean, this is a high-powered woman. You know, her significant, considerable demands on her time, but she's going to take time to talk to her clients, her consumers, okay? I've seen many other bank presidents at local community banks doing the same. Ask your bank what percentage of its deposits are insured. And more specifically, are your deposits insured? Do you have more than $250,000 at one bank? And maybe you should spread that around to another bank, okay? What is the loan to deposit? That should not be ration, that should be ratio, okay? Do they have more loans out than deposits they have, okay? Do they have liquidity to be able to sustain a demand on consumer withdrawals if that were to happen? And finally, there's something else called their Bauer Star Rating. There's a company that basically rates banks. You can actually scan that QR code. So get out your phone, open up your camera and scan that QR code, click it, and it will take you to the website where you can type in the name of your institution, and they rate banks and credit unions. And you can see, what is my institution's rating? So I wanted to share that QR code with you right there, and I'll leave it up so that you can get that. But remember, bigger is not always better. Bigger banks often have bigger risk exposures. I'm not sitting here being an advocate just for small banks, but I'm simply saying you might want to spread your risk around to different institutions. And typically, the smaller the bank, the more likely they are to have a personal relationship with you. All right. So I don't see any other questions. It is just a little after 1 o'clock, so I will let you go. I appreciate you sticking with me a little longer than normal today. I'm going to leave you with this thought, okay? I always like to leave on a positive note. It's concerning what's happening with these banks. But again, we do not believe that it represents an overall rot within our banking system. What it does represent are individual banks that have overextended themselves, and yeah, probably some regulators that have either turned a blind eye or they just haven't really done the work they're supposed to do. That happens. But I do not believe it represents a total collapse of our banking system. I still have a lot of confidence in our system, in this country, and we will get through it. We will. We have before, and we will again. As always, you can reach out to me if you have any other questions, especially our clients. And I will end for today. Thank you so much for joining us on the Wednesday lunchtime drive-through. I hope you have a great rest of your week. We'll see you next time. Bye-bye.